Hello everyone and welcome back to the Torrin Dove Financial Channel. As you all are very likely aware, we are in the midst of a frothy market. IPOs are going crazy, earnings are coming out, and we're seeing big swings regardless of whether or not a company beats earnings. If they do beat earnings and not beat them necessarily enough, we're seeing some go down as far as 20%. And on the flip side, if companies are even slightly beating expectations, some of them, specifically in tech, we're seeing crazy jumps. And it comes down to really everybody's kind of paying attention right now. They're all focusing in, and everyone is pouring money into the markets. We seem to have kind of forgotten a bit the whole entire idea that we're going to see a major pullback, and people have just come to terms with Liberation Day being that pullback, and we're now okay to see frothiness in the market, regardless of the fact that things have not necessarily, per se, gotten better. We got expectations. Where it ended up actually coming out was slightly better, and so we kind of ignored it and have continued to fuel this train. And so I thought this was a great time to go over probably one of the most misunderstood topics in all of finance, and it boils down to when you actually sell a position. Now, when I say it's one of the most misunderstood topics in all of finance and all of investments, what I really mean to say is that everybody, of course, knows there's an expectation to sell. Even people who know nothing about the stock market know that you buy low and sell high, or at least in theory. And for some of us, that looks more like buying high and selling low. But really, when I say misunderstood, there's a lot of factors that kind of go into when you'd actually want to sell. And I know when I kind of first started investing, obviously not doing the smart thing and reading and coming to understand things well before I started investing, I made a lot of what I would consider careless rookie investing mistakes based on my misunderstanding of when to sell. And so what I'm hoping to do in this video is, even if I can get one person to avoid making similar mistakes as myself, not only will I be able to make them more financially well off, but I'll also be able to kind of push them towards the light. So really quickly, I'll give you some personal background on some of my, what I would consider, biggest selling blunders. Now, when I first started investing, I made my single best investment I've made to date. And I actually opened up two accounts. I opened up a Roth IRA account, and I opened up a brokerage account. And in my Roth IRA, I made the great decision of not really trying to beat the market at all and just kind of participating. And I put pretty much all of my money into VOO, the Vanguard S&P 500 ETF. And this has definitely been one of the things that I've looked back on and will continue to be probably my largest investment vehicle. Now, there might be some slight tweaks in terms of adding international ETFs as I get more along my career and definitely make more than right now with me being in college and not necessarily employed at a financial institution, which I hope happens in the future. But that being said, on the contrary, in my brokerage account, I at first started off kind of doing a similar strategy, but I fell into what I would consider the boredom of passive investing. Now, passive investing, as I have gone over on this channel, is the ideal way to invest your money. That being said, it can both be true that the ideal way to invest your money can also be quite unexciting. We all know that parking our money for long term is good, even if some of us may not be able to attribute that to compound interest or know kind of some of the fundamentals or the stats behind that. We all know we are supposed to park our money deep down. That being said, it becomes a lot more fun if you are, at this point, I didn't even view them as ownership shares. I viewed them kind of how you would trading cards. I was taking ticker symbols and trading them for money. And this was a time where it was really, really fun for me, and I was constantly looking at things, and it was a lot of fun. That being said, 5 years later, there have been some mistakes, I would consider mistakes, that I've looked back and realized how much I shot myself in the foot. One of those being, I was not the earliest by any means investor in Nvidia, not saying that, but like 4 years ago, I did have a considerable amount of shares for Nvidia for someone my age, and I didn't really know the fundamentals of the business. It had popped up on a screener, and it had also been popping up in Yahoo Finance News, and there was kind of this idea of the will they, won't they, and as many investors do in their average of 6 minutes of research per time, I couldn't really explain the business model. And the only reason I had for investing in them was because everyone said they were going to do well, and they were doing well. They were doing well in a very, very fast amount of time. My shares appreciated in value 45% on the dot. Now, if any of you guys would like to, for the fun of it, go look at NVIDIA in the past 3 years even, and look at the percent return on that. This will give you some insight into why I consider this to be one of my dumb mistakes that I really, really well learned from. I didn't understand the concept of selling necessarily. Well, I knew how to sell, and I feel like a lot of people know how to sell. And we're kind of ingrained that, at a certain point when you're really, really up, it's time to cash in, take your profit, and leave. But when is that point? That right there isn't necessarily a mentality that's going to be good for long-term investing. And as I've looked back over the years, that decision to sell when my shares were up 45% and go, woohoo, yay, look at me, I made a decent amount of money, was a really, really bad decision at the time. And it makes sense why this kind of narrative of you want to lock in your profits and buy in, continually buy low and sell high is kind of ingrained in people, even who don't know anything about finance, and that's simply because of the transaction costs. A lot of the companies that you're investing through do benefit from a frequent number of transactions, and they kind of push this trading mentality onto you. I mean, typically, even when you look at some of the platforms and how they advertise, it's very much like the Robin Hoods and even the Charles Schwab, which is more like a full service brokerage, even how they kind of advertise to people in my younger demographic, it's with the Thinkorswim trading platform. It's not with the idea of becoming a long-term investor, and that's because they don't necessarily profit as much if your investment style is parking it into long-term positions and holding for compounding interest and trying to actually grow your portfolio for the long run, versus if you're just trying to make frequent profits. Now, here's the thing. Over time, my goals in investing have shifted, and a lot of that just kind of boiled down to because I didn't necessarily have a full idea of what I wanted to do. In my Roth IRA, I was 100% confident because I had a Roth IRA that was money for retirement, and so I was not trying to make any money substantially in a very, very quick period of time. And that's why it was really easy for me to kind of consider that money that I'm not touching for 40 plus years. And so that was really easy to just kind of park and let it sit there. And then in my other account, which I didn't necessarily have an idea what I wanted to do with it, I just wanted it to grow, I was prioritizing trying to make these quick, fast transactions because, well, obviously dopamine. I mean, there's a reason that gambling's a thing, and that right there is taking a game that is in your advantage with long-term investing and making it a game that is not so much in your advantage, or if it is in your advantage, it's to a much lesser degree of long-term investing that has a much better track record. And so really, I think where a lot of the mistakes kind of come in terms of when you're selling will boil down to, do you actually know what your goals are with your investments? If you're trying to think long-term and even outside of 5 years, you should not be looking for the first chance to sell your things. Now, a lot of people, what they like to do is the second something turns red, they just let it go, regardless. And there is a very, 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 very large chance that investments inside of your portfolio will be red at some certain point. Even when we look at a name such as the market darling of NVIDIA, there have been times where if you had invested at highs for 2023 that you would have come down and said, oh, I'm in the red. And if you're just under the impression of any time it turns red, I'm going to sell and I just want to only hold on to the winners, then you're not actually looking for value. You're just kind of holding on to things you might have gotten at a terrible valuation. And so that's why I would try to impose my method of actually understand what your financial goals are and what your intentions are with your investment portfolio before you go ahead and start selling, especially frequently selling different positions. Are there times that it will benefit you to just outright sell things? Yes, tax loss harvesting is real, and especially if you're someone like myself who primarily invests in, I don't go outright and search for it, but primarily the vast number of my holdings do pay some sort of dividend. This is a great way because I reinvest all of my dividends. There's a amount of research that implicates that if you are trying to be a long-term investor, you should be reinvesting your dividends, but that's a different topic. But if I'm somebody who wants to reinvest pretty much all of my dividends and that counts as income, if I can actually take some of my positions and whittle them down when I have losses in them, then I can actually report losses as income and it will benefit me on the taxes so I don't have to pay any taxes on the dividends I got. So there are definitely benefits to tax loss harvesting. It's just that a lot of people aren't necessarily selling it for those reasons, and they don't even necessarily know that that's a thing for them. So really, more than anything, what I'm trying to promote in this video is an understanding, a comprehension, and taking the time out of your day to think whether or not your investment goals are being met by the strategy in which you are selling. If you're frequently selling and hopping in and out of names and companies, then there's a good chance you're not doing enough research in your selection process. And also, if you do have a position that's a very, very large gain, has a very large gain, identify why you want to sell it. If I'm trying to buy ownership shares in companies, right, and it's just a company like right here, I own 3 businesses or something, and one of them has great management, they have a superior products to others, maybe they're even a monopoly if you're able to be fortunate enough to identify a monopoly, and they have great margins, good investable margins, and a fantastic balance sheet. Would I immediately turn around and sell it because my neighbor next door is offering me a 30% return from where I bought the business? Or would I look at all of the factors and consider some of the growth potential and growth prospects of the business and see if I believe the company is in a position that they can actually grow against competitors, or if there aren't even competitors, they have pricing power, and do I think that they will be able to grow in the future to become significantly larger than that 30% I'm being offered short term? A lot of people fail with the concept of delayed gratification. They are in it for what is the best benefit to me right this possible second. And of course, there are going to be situations where you do need to think like that. Not everyone is going to be in a financial position where they can even justify thinking a year down the road. There are a large number of Americans who don't even necessarily have a lot saved up. And so again, if you kind of understand your full situation, understand what you want each of your positions to do, and I would also add that if you primarily are investing long term, but you do love some short term active management, open a separate account. Separate your accounts. Let one of them be your really easy, great conviction, long term bets necessarily. And then let the other be your more actively managed thing. So that way you aren't getting tempted to sell any of your long term solid positions in order to make speculative money. So overall, I hope that helped a little bit. It was kind of just boiling down to a reminder to actually do your due diligence, take your goals into account, and understand each and every position inside of your portfolio. And if you just do those things, you're going to outperform the significant amount of the average investors. Absolutely blow by them, because so many people don't actually know what their goals are with each and every position. They come into it with a very simplistic mindset of, I want to make money. Here's the thing. If you're investing at all for a long period of time, you are going to make money. Making money in the stock market is a very, very, very easy, obtainable goal. I mean, the market itself, when we talk about the S&P 500, has practically returned 10% for well over 20 years. You are going to make money. You need to have a goal outside of just what does making money look like. What are the returns you want to expect out of a company? What are you expecting that company to do in the future? If you aren't sure that you can actually kind of break down and evaluate different positions and have a comprehensive understanding of what those businesses do, I again implore you. I have multiple videos where I go over just how amazing ETFs are. ETFs are a game changer. They're incredible. There is absolutely zero shame in acknowledging the fact that maybe you don't understand absolutely everything about investments and you don't have the time to evaluate business models and come to those conclusions. There is zero shame in it. It's not giving up to invest in an ETF. It's actually probably the single best decision you can make with your money. So again, if any of that sounds complicated and you just want to avoid the idea of when to sell and having all of those questions entirely, then it is perfectly reasonable to just park it into ETFs for the long term. Okay, thank you very much. I really appreciate your time, and thank you for checking out my video. And if you made it this far for some reason, well, thank you very much. But also feel free to like and subscribe to the Torin Dove Financial channel. Thank you.